Trust Company. I am super excited to have with us today Jason Bible out of Houston, Texas, talking about how to raise and invest money legally. A huge topic of conversation right now. So I'm personally really excited to see today's presentation. But before we get started, I do just have a couple of quick announcements for you guys, kind of as we let people get signed on here, let you know a little bit about who we are at Quest and our events and promotions that we have going on for you guys right now as well. So I know in these webinars, we get a lot of new people joining us every single week. So if it's your first time joining us for one of these classes, welcome. We host a lot of webinars and events every single week, and I hope that you guys find value in today's education. Now, at the core of our business, Quest Trust Company is a self-directed IRA custodian. So basically that means we help investors all across the country learn how to use their IRAs and retirement accounts to invest into non-traditional assets outside of the stock market. So our clients use their IRAs to invest into real estate deals, passive private lending, investing into multifamily or commercial deals, which is probably a large chunk of what we're going to talk about today. But guys, there's a lot of people out there doing this with their self-directed IRAs, but 98% of retirement accounts in America are only invested into publicly traded securities. So at Quest, we are extremely passionate about teaching investors, not just about self-directed IRAs and how they work, but also about your different investment options. And most importantly, how to do these deals the right way with the right documentation, due diligence, and, making sure that you are structuring your deals properly. Now at Quest, we do have about $2 billion in assets under our administration. All of that is all privately held assets that our clients have self-directed their IRAs into. And we've got about 100 employees. We are all based in the state of Texas. Our corporate office is here in Houston. But again, we have clients all across the country, and we do operate in all 50 states. Now, really important, the last bullet point on this slide here, please be aware that at Quest, we do not give tax, legal, or investment advice. We put on a lot of education. We bring in a lot of different guest speakers, but please be aware, we are not your attorneys, we're not your CPAs. Our role in these scenarios is to process investments for you guys to be able to invest into these non-traditional assets with your IRA accounts. So please make sure that you are doing your own due diligence before you enter into deals, and make sure that you're taking the time to vet the people that you're working with and to use professionals as well. Now, that was for all the new people. Thank you guys for joining us. I hope you enjoyed today's class. But if you are a current client and you've been joining us for these webinars for a while, be sure to check out our online client portal. We have added a lot of new features to the online portal within about the last year or two. Now we actually have some really cool features through there where you can actually upload all of your investment information and documents directly online to the client portal. It'll go directly to your transaction specialist, and you can get real-time updates as your investment goes through the review and funding process. So it really kind of helps to speed up that process as well. To get to our client portal, just visit our website, questtrust.com, click the login button at the top right, and be sure to check out some of those features that we have through there. If you ever need to update your account information, you can also do all of that directly online through the portal as well. Now, as I was mentioning, today's class is just one of many different educational opportunities that we host here at Quest. This is just a list of some of the many classes that we have on our website and our YouTube channel as well. If you want to rewatch today's class, as well as any of the other classes that we've recently hosted here on our platforms, be sure to check out our YouTube channel. Our YouTube is a fantastic resource. It has all of these pre-recorded classes. It has shorter videos that kind of condense it down to under 10 minutes for you guys. Or you can rewatch all of our live webinars that we've hosted with all of our guest speakers for pretty much the past 2 to 3 years. We've been live streaming our events online for several years now, but at the beginning of the pandemic is when we really got into live streaming everything on YouTube. So you can find all of that information there. And if you guys check out the chat here in Zoom as well, you can see that I do have one of our other IRA specialists online with me today. His name is Kurt. He will be moderating today's webinar, and he can send you guys these links if you have any additional questions. Now, for some of our other upcoming online events that we have going on right now, currently all of our events are still online. I'll talk about that more on the next slide here, but you can watch all of our self-directed IRA Saturday webinars, our weekly webinars, our big mixers that we host, all online through Zoom and YouTube. Now, if you guys are looking to network with other investors, be sure to join us for our virtual networking happy hours. I actually started this event myself several months ago in the midst of the pandemic because I was getting people calling me almost every single day asking when the in-person events were coming back because everyone really missed the networking. So just due to that, out of necessity, we started a virtual happy hour. It's twice a month. It's on the first and third Wednesday. And at every happy hour, we get about 35 to 50 investors from across the US joining us. And everyone actually gets a chance to share their cameras, introduce themselves, and then we open it up for conversation at the end. So you can meet a lot of great people on this event. It's attracted some really high quality investors, and I hope to see you guys join us at some of these upcoming events. Now, on to the not so great news. You guys know that we were really gearing up for our big grand opening events here in Texas. Unfortunately, we did move the remaining Austin and Dallas grand opening events online. But I guess the slight good news out of this is if you guys are not in Dallas or Austin, you can now watch all of the case studies that we were planning on presenting at these events completely online through Zoom. So Kurt will send these links in the chat for you guys. You can scan these QR codes. It'll still take you to the right place. But, just due to everyone's safety and abundance of caution, we did decide to move these events online. So I hope that you guys are all staying safe out there, but definitely be sure to join us for these events because we'll have Jason, we'll have a few other speakers joining us and presenting case studies of deals that they have done throughout the last year. And last but not least, we do have a pretty cool promotion going on right now. I really like this one because it is great for both new clients getting started with Quest or existing clients. So if you're a current client with Quest and you are getting ready to do another deal, maybe you're looking to move some of your funds back over into your IRA with us, we are giving away up to $500 in account credits. This can cover your transaction fees, it can cover your annual fees, and depending on how much you're looking at moving over, you could potentially earn up to $500. So again, Kurt Power, my sidekick for today's webinar, he is online in the chat with you guys. If you have questions about this, or if you are an existing client looking to take advantage of this promotion, reach out to Kurt directly. He's one of our top IRA specialists, and he can definitely help you with this process. Now, this does go through the end of the quarter, so you guys do have some time, but make sure you get the ball rolling because you never know when that next deal might come across your plate that you might want to use your IRA for. So that's about all that I have for my announcements for you guys. Here at Quest, we really pride ourselves on being very easy to get a hold of. So if you ever have IRA questions, technicality questions, can I do this investment with my IRA? Reach out to us. Give us a call, send us an email, or just visit our website at any time during our business hours. You can actually chat live with an IRA specialist. It's not a robot. It's not someone off way somewhere else. It's actually our IRA specialist on that website chat. And we're always happy to help answer those questions for you or help you get started if you are ready to take control of your retirement. So without further ado, I'll go ahead and pass off the torch to Jason Bible. Jason, I'm excited to hear your presentation today. If you guys have questions, put them in the Q&A box and we'll come back on and answer those at the end. So Jason, go ahead and take it away.
Okay, great. Haley, you can hear me? I sound good?
Yes.
Okay, perfect. All right. I am, this will actually be tonight's case study. I'm sitting here in the Texas Real Estate Investment Center. We bought this office building in the middle of Corona last year, and you guys are live here in my actual office. So, and I'll talk a little about that tonight. Everybody thought we were crazy when we bought a commercial office building in the middle of Corona, and I'm like, trust me, this is going to be a great deal. So, this is me, Jason Bible. That little QR code in the left-hand corner, everyone asks for my contact info. They ask, how do I get on your Facebook and your Instagram and your email and your phone number and, how do I get on your email list? All you have to do is hit that QR code and a page of mine comes up and it's got everything in there that you could ever want. So if you guys scan that, you can get all my contact info. I've been really enamored lately with some of the things that Jim Rome and Jordan Peterson have been saying. And I think it really goes back to what is it that you want to accomplish in real estate? What do you want to accomplish in life? And so I've just put a couple of those little quotes up there that I've just been a really big fan of here over the last year. This is my favorite one. If you think real estate is expensive now, just wait. I said that on our nationally syndicated radio show in October 2017. So I like to remind everybody what the cost of waiting is. This is the median home price in Houston. In October 2017 is $227,000. In June, which is the last month we've got data for, it was 315 grand. So the median home price has appreciated $80,000 in 4 years. It's 20 grand a year. So every single presentation I do, I remind people of this. Every minute you wait to go do a deal in real estate, it's costing you a ton of money. So everyone's always looking for the perfect deal. There are no perfect deals out there, just like there's no perfect people. Just buy it. Just buy it. I have to give you guys a bunch of disclaimers. We're talking about money and funds, and I own a bunch of syndications, and I own 2 funds right now. I'm a real estate investor. I do first deed of trust lending, but I'm mostly somebody who buys single family, Airbnb, small apartments, those sorts of things. But anyway, so my attorneys always tell me I got to put a disclaimer up here, and then here's another one, and you can read those at your leisure. But I'll give you my favorite disclaimer. This is my favorite disclaimer here. I'm not a CPA, attorney, a doctor, an auto mechanic, an IT professional. In fact, just regard me as a common criminal. In fact, little funny note about me, I have 2 warrants out for my arrest because the city fined us for something. We actually had a court date and everything, and we never got the mail. So I've got 2 bench warrants out for my arrest for not cutting the grass on 2 properties we bought. I don't know how long ago. So don't listen to anything I say. It's probably the best way to say it. I'm a common criminal at this point until my attorneys get it all sorted out here in the next 2 weeks. But the biggest mistake I see people make in real estate is they get advice from professionals, but then they never use it. Hey, Jason, my attorney told me this, or hey, Jason, my CPA told me that. I'm like, okay, well, did you do it? They said you were supposed to do it. And they said, no. I was like, well, what did you pay them for? Like, that's really the biggest mistake I see a lot of real estate investors make, is not taking the advice of real professionals. I'm Jason Bible. I am Mr. Texas Real Estate. Our vision and mission over the next couple of years is to turn 250 people into real estate millionaires. And how are we going to do that? We're going to invest in Texas real estate. I got to be honest with you guys, and I know that this is an international group, but for those of you who live in Texas, there is no better market in the world than Texas. There is not one. Trust me, if there were, I'd be there. And there's no better place. I've always find it fascinating when people from Texas invest out of state. I'm like, you don't get it. It's way better here. I can show you all the math behind why that is. But it's an absolute amazing place to be. This is what we do. We got about 25 mil under management, 7 mil in equity in less than 18 months in one of our funds, and then we manage about 300 doors of small apartments. This is me. I started out in risk management. My undergrad's in environmental science and chemistry. I worked in healthcare, biomedical research for 15 years as their risk manager. It was a great job, loved it. I was not one of these guys that's like, you need to quit your job because it's, you need to be your own boss, and my work sucked. I absolutely love it. In fact, I still go to the Christmas party every year, and I've not worked for these people since 2013. So got into real estate and flipped about 100 houses a year for a couple of years until I moved over to buy and hold. This is my business partner, Rob. You guys have met Rob. He's a California investor. Worked for all the big hedge funds out in Southern California. Did rehabs for them, helped them with the acquisitions. Just a really interesting guy. And then my other business partner here is Brian Burr. If you guys have been in Houston for a while, you'll know Brian. Great guy. He's the one that helps us out on the fundraising side. So if you guys see something here that you like, or we've got a relationship and you're interested in one of our funds, that sort of thing, Brian's the one you end up talking to over here at our office. All right, so let's talk about going to jail, allegedly. So for years, the Securities and Exchange Commission, who regulates securities in the United States, was only going after like really big players or, like the Bernie Madoffs of the world, that sort of thing. However, something has happened in the last 2 years where now they're starting to go after, quote, the small guys. And this just came out June 29th, that some people are being investigated and indicted. In fact, we know a handful of them. I don't know this guy personally, but I believe Rob does. We've actually told some of these investors, hey man, you want to be really careful the way you're raising money. So the Securities and Exchange Commission is starting to go after small players. And how do I know this guy's small? From 2015 to 2020, he only raised $9 million. Like, that's, in the syndication money raising space, that's nothing. So he raised $9 million for his fund, actually for his syndications. And he did a lot of things wrong. Well, allegedly. We're still in allegedly, right? Allegedly did a lot of things wrong. Guaranteeing double-digit returns. There may have been some personal expenses that were mixed with some of the funds. It also sounded like there were people that he may or may not have been paying to help him go raise money. In other words, he was paying referral fees for people to raise money for him. So there's a lot of stuff going on here that I hear in rooms all the time. I go to real estate seminars and networking events just like you guys do. And my business partner, Rob, and I, somebody will say, hey, Jason, I'm doing X, Y, and Z. And, let me get you on a webinar. Let's talk about a deal you can invest in. And then I tell them, like, hey, you realize the way you're doing this is completely illegal. And we're going to go through some of the biggest mistakes. This is by no means all of them. And again, I'm not an attorney. There are 2 law firms that I recommend in the United States to do securities work. And we use one of them, and the other one we know, but obviously. But this is why we hire the best securities firms in the state, in the country, especially as it relates to real estate, because they deal with these issues all day long. So I'm not an attorney. These are not all the potential pitfalls you can run into, but these are the biggest ones I see, not just nationally, but even here in this marketplace. So we're going to go through those here in a minute. Let's talk about note. There's really 3 things that most real estate people raise money for: notes, syndications, and funds. And notes, your typical first lien position notes. Syndications, apartments, and commercial. I separate apartments from commercial real estate for a couple of reasons. I don't want to get into why that is. And then we're going to talk about funds. And we've done all 3 of these things and are active in all 3 of those markets. So let's talk about a note real quick. For those of you who are a little more seasoned, hang on with me for about 5 or 6 minutes here as I get into some of the places where you could run into some issues. But I just want to make sure we're kind of all on the same page here. Promissory note is real simple. It's just money loaned to another person. And it's usually a contract. Well, there should be a contract in place. And in real estate for us, it's typically, I got a buddy of mine that's got $200,000. In fact, I'm buying a beach house this week. $380,000 beach house. Got a buddy of mine that's got an account, let's say over Quest Trust. And he goes, hey man, I got like 400 grand in there. You got anything you can use that on? I'm like, well, I'm buying this beach house. You want to put, 380 grand into it. That'd be great. And he goes, okay, cool. And then we have the attorneys write up a note for it. So it's super simple. These are common terms that you'll see in the contract. Is it secured? Is it unsecured? Who's the borrower, the lender, the principal amount, all that. I'm not going to go through this stuff. I'm sure Quest Trust on their website has got videos of people talking about this. To be quite honest with you, I find it incredibly boring. So that's why we'll let the attorneys draw this stuff up. And then here's where things get really interesting. So people will tell me, well, Jason, it's just a note. And like, I met this guy at a conference, but he lives in Louisiana, he lives in California. And then like, he wants to do a note with us here in Texas. And I'm like, well, here's the problem. Money starts crossing state lines and becomes subject to federal law. And technically, the SEC defines a note as a security. So what ends up happening is someone starts borrowing money from somebody in Minnesota or wherever they met at some conference. And it's like, well, you may be running into some issues there with regards to the SEC. Now, this is something we see quite often here. According to the SEC, you're not supposed to advertise. So I'll see somebody put a message on Facebook, or they'll send out an email blast to some book group of random emails they got from a real estate event. And they'll say, hey, we got this deal, it pays 90% or 10% or 5%. Who's interested? They'll pool money. And there's all kinds of stuff that's outside of just family and friends. Now, don't get me wrong. There is some exemptions here where you do not require, to have a conversation with the Securities and Exchange Commission. However, what I see a lot online and in this marketplace is folks that are borrowing money and in some cases pooling money across state lines. And the Securities and Exchange Commission is pretty clear on what that actually looks like. However, even when you are borrowing from family and friends, there's still some disclosure docs that have to be filled out. So we'll get into some of that here in a minute. Here's another problem I see, and that is with usury. State of Texas, we've got a usury limit of 18%. And most people think that's just the interest rate. No, it's all the points and fees and all that other stuff. So one could run into an issue where they're paying, let's say 10, 12%. Let's call it 12%, and then you've got 5 points on top of it, so it's 17. But then the loan pays off in a handful of months, or 6 months, or 8 months, or 9 months. Well, the problem is when you annualize that out, maybe you add some of the other back end fees, front fees, that sort of thing. All of a sudden you're up above usury. That happens quite often. So for those that are lending, you've got to be really careful. And each state is a little different. Here's the crazy thing most people forget is that real estate is different state by state. Hell, in some places it's different city by city. If I go down to Missouri City and have a rental property, the city actually has a permitting process for rental properties. You can't just turn a house into a rental property there. Conversely, you can go just about anywhere else in the city and nobody cares. So when people ask me, hey, Jason, do you invest out of state? I'm like, look, I got to learn a whole new system. I got a whole new set of laws. Securities laws are different from state to state. We've got federal law and then we've got state law. And then we've got, well, if we're bringing funds in from outside other states, that state may actually have different laws from repatriating those dollars, if you will, to use that kind of term, back into the state. So I don't want to be an expert on all that nonsense. I want to be an expert in real estate. And the joke we have around here at the Texas Real Estate Investment Center is, look, if I can't become a billionaire by buying and selling real estate in Houston, Texas, I have screwed up somewhere in my life. So there's plenty of real estate locally where you don't have to learn all the laws from other states. What makes a note legal? Pretty simple. Promise to pay, the amount owed, borrow signature, in some states a date. It's pretty easy to put together a note these days. And be quite honest with you, we don't do it. We have our attorney do it. Of course, you're going to have these other things. Who's the borrower, signatures, due date, interest rate, what happens if it's late, how do you take it back, are they balloon payments? I mean, you work through all this. You work with a seasoned real estate attorney, not one of these fly-by-night guys. And in fact, how do you know if you're at a networking event and if someone's a seasoned attorney, you find the person in the room that's maybe doing the case study, or you find somebody in the room that's usually got a group of people around them. They're all talking about real estate. It's like, hey guys, who do you use as an attorney to write up your notes? And they go, oh man, talk to this guy, they're great. So even if you have a personal family law attorney, you wouldn't have them do this. This needs to be somebody who's kind of specialized. And then of course, the question I always like to ask you guys are doing notes is what happens when it goes bad? Like that's always the discussion. What happens if things don't work out? All right, this is provision. Other lenders might want binding on errors. What happens if there's a late payment? When is it considered late? How is it calculated? Is there an acceleration clause? And the borrower may not assign the note. So there's all kinds of stuff in there that you guys can add. Prepayment penalties, if that's the case, due on sale clause. I mean, there's all kinds of stuff in here. It's actually one of my favorite lenders to work with. They actually have a cross-collateralization clause, which I always thought was really interesting. So, and they have a cross-default clause as well, which is really what that one down there at the bottom is. Other provisions borrowers may want, just a ton of stuff here, right? Refusal if lender wants to sell the note. Our lenders are not allowed to sell our notes. Like that's specifically in the documents. We don't want them selling notes because we don't want to deal with another lender. I will tell you right now, there are shady borrowers in this marketplace, and there are shady lenders too. Everybody likes to kind of put lenders up on this pedestal, and I'm like, man, trust me. In fact, I'd almost argue there's more shady lenders than our borrowers, but that's a discussion over a couple of beers sometime. But yeah, we put specific remember, this is not a one-sided contract. It's agreement between two parties. I'm gonna borrow your money, and I'm gonna pay you an interest rate on that money. It's pretty simple. So, all right. Loan or JV. This is where things get interesting. So, what I have found is some people will put together a loan, but then they'll also do a joint venture. And what I really find is going on is that someone wants to JV because they kind of want to be a partner for the upside, but they don't want the risk of the downside. So they do this weird JV, but we got a note, but there's an equity thing here, and we might be in the middle of usury. It's this weird sort of thing. And I really don't recommend it. I recommend things to be really clear, and I'm going to explain why here in a minute. So on notes, and even in joint venture agreements, you really can't pool money. Here's what I found. Actually, we'll just skip down to the last two here. I find people advertise joint venture agreements. Oh, I got this great JV, who's in? Now, let's be honest, no one's stupid here, right? So what are you really doing? You're trying to pool money without doing a syndication. But then you're also advertising, so you're trying to pool money without a syndication, but you're trying to advertise like you're a fund. None of those things are legal. So, but if we call it a joint venture, then we can do it. And I can tell you that's absolutely, you can't. So a lot of people will come up with this really clever vocabulary and really clever marketing terms. And any attorney who's been a securities attorney for about 7 minutes will look at that and go, dude, you're breaking the law here. Like, you can't do this. So I find that most use a joint venture to avoid usury, meaning they would put together the lender, the guy that's bringing the money, would avoid usury if we call it a joint venture agreement, even though they have a note, like they're trying to structure it like a note. And then the person raising the money likes to play the game that they're not really in a syndication. They're not syndicating money, but really that's exactly what they're doing. You can use tenants in common, but I'll tell you right now, most people don't do it right anyway, especially on pro rata ownership. I'm not going to get into all that on today's broadcast because we've only got 20, 30 minutes left. But most people don't do tenants in common right because then there's no pro rata ownership based off who's putting in those dollars. So it's this really convoluted thing. And I can tell people kind of learn this at a real estate seminar or a discount attorney where they're like, well, you could do this, but you then could do that. And I'm like, yeah, but if you go over to subpart C over here, it says you can't do any of that. It's crazy. So just keep it, Rob and I have a saying here at the office, just keep it clean. Like, keep the relationships really clean, keep the docs really clean, and then it's really easy to move through these joint ventures and syndications, that sort of thing. All right, so here's how the professionals do it. We put together syndications. You can pool money. It's called a syndication. You got to have a syndication agreement, and you can do anything with syndications: hotels, apartments, developments. I'm looking at doing a bar right now, a bar and a restaurant, and bar kind of turns into a bar in the evening at a club. We're going to do a syndication for that. It's going to be our first foray into the entertainment business, but we're totally going to do a syndication for that. Another project we're looking at is I'd like to do a ground up project. But we've done a zillion syndications before, and the case study tonight is actually going to be a syndication. This building's not a syndication. It's actually a joint venture agreement because we do have a real partnership. But a lot of our apartments and other stuff are in syndications. It's the standard way of doing business. Kind of everybody does it. It also allows some interstate investing. So I like to ask this, where's the money, right? Follow the SEC rules and disclose. And you may have to register in each state. So if you guys look at our stuff, it's all registered with the state of Texas. And then our funds are registered with the Securities and Exchange Commission. So it's like, that's the standard way to do business. And if you ask your attorney and they don't know what you're talking about, then you might need to find a new attorney. But when you start borrowing funds from outside the state, there's going to be intrastate rules. Let's say I don't know the state rules in Louisiana, but Louisiana is just next door. So if we've got some friends of ours that want to do a syndication deal with us and we're bringing the money over from Louisiana, there may be some rules in Louisiana where we have to register that syndication. Conversely, there's some different rules that are here in Texas. So each state's a little different. So when you start bringing in these dollars from all these different places, there's different disclosure requirements. So, well, what happens if you don't do that? Well, it's real simple. I mean, you're now breaking securities law of that state, maybe doing it at the federal government level too. So you've got to be pretty careful with a lot of these things. And then you got to identify the investor. Who is it that's investing? Are they accredited, sophisticated, unsophisticated? You guys can Google that up and pull it down on Wikipedia and tell you exactly who those people are. And truth be told, here's what's crazy. I see syndications all the time that get advertised. and they'll advertise it on their email list, their Facebook group. None of that is kosher. And I see it all. I get solicited daily for syndications. And I'm like, I know I don't know you. Now, I know you by reputation because you run some real estate club, but I don't have a personal relationship with you. Why are you sending this to me? And unless there's a real relationship, and let me preface it with this, a real documented relationship. This is not a, hey, I met you at a real estate event and we drank a couple beers together. Like, you have to have a real documented relationship. And what 9 times out of 10, this is how people really do it wrong. They will meet somebody at a real estate club, they'll meet them at a RIA event, they'll meet them at whatever, and they're going to talk about the syndication that they're in, and they're going to consider that the relationship, and that's not the relationship. That's not how it works. You're pitching to strangers, which is something you can't do. All right, so we're involved in funds. I'll go through these real quick. Crowdfund 5063, and then of course there's a Reg A Tier 2 fund. At the end of the day, you kind of pick the fund that meets the investment strategy that you're employing, right? So these Reg A Tier 2s, these are the funds that you see out there that a lot of the really big guys are using. Just because anybody can invest, you can take as little as, I want to say it's $5,000, which I personally wouldn't deal with folks that have got as little as $5,000 to invest. These Tier 3 funds, the same thing. You can advertise. There's some limitations there. You can raise up to $1 million. This is what we do. I like to call this the elite level. We have 506Cs. We've got an unlimited raise. It's only for accredited investors, and yeah, we can advertise. So our Texas Appreciation Fund is, and our American Recovery Fund, which we just closed, like right after we opened it in COVID. We did a full raise, boom, we were capped, and then we went on to go open the next fund and stabilize those properties. But this is what we do. Legal is going to cost you about 115, somewhere between 100 and 115 grand to set up. And then of course you got to have some advertising, you got to back up. In fact, the office next to me is Brian and Jamie's office. I just interviewed another investor relations person tomorrow. So when you start to get it to this level, it's actually a whole business in and of itself. The caring for other people's money. That's really what's going on here. You need to have a professional staff of investment relations people. Jamie, who runs that department for us, worked for C-level executives for years. So she's very accustomed to that. Of course, that's Brian's department as well. So if you guys end up having a conversation with us, that's who you talk to. And then the question is, what do you do with the money? Well, you can do just about anything with it. I mean, when you got a fund, the only limitations you have is what you wrote in the fund docs. So you could go in and buy whole companies just to get at their real estate. I mean, there's all kinds of cool stuff you can do. We essentially have our setup as a blind pool, but it's all holding single family real estate. There's some Airbnbs in there, but mostly it's all single family real estate. You can really do anything as long as it's all documented, the SEC approves of it, your attorneys are cool with it. I mean, you can do just about anything with it. One of our next funds is actually going to be a note fund, and that one's going to be a ton of fun. But let's talk about the biggest mistakes. So you guys kind of got a flavor of some of the challenges that folks have to experience when they're raising money. But here are the 3 biggest mistakes I see. The G word. Does anybody know what the G word is? It's guarantee. It's guarantee. I see this all the time. Jason, we guarantee this, we guarantee that. G word, G word, G word. You might as well remove the G word from your vocabulary. The Securities and Exchange Commission and the Federal Trade Commission classify real estate as high risk. So the federal government says it's high risk, therefore you can't guarantee anything. According to the government, the only thing that's guaranteed are treasuries. That's it. So if you're not investing in T-bills, like there's no such thing as guarantee. Here's the other thing. There's a lot of quid pro quo that I see happens in these marketplaces where, hey, Jason, if you bring me $1 million, meaning you find me $1 million for my deal, I'll cut you in for a percentage of the deal. Or they'll pay referral fees. Hey, you bring me $1 million, I'll pay you $1,000. Hey, you bring me an investor. In fact, it may not even be money. It may just be, hey, if you bring an investor, I don't know how much money they got. If you bring me an investor, I'll pay a referral fee. In fact, for those of you who are real estate agents, not only is that not legal from a security standpoint, it's not legal for your real estate license either. I mean, the banking laws have changed, just completely changed all that, even with regards to mortgages. So, and then here's the weasel words. They'll say, well, we're not really paying referral fees. We're not paying for, we're going to do a partnership instead. Or we're a matchmaker. I look for investors that have got money, and then I match them with deals that need that money. I'm like, no, you don't have a securities license, and you're being compensated for your ability to raise money. Completely not legal. And then the other thing I love is dating service or capital. Well, Jason, I match money with deals, and it's kind of like a dating service or capital. I'm like, no, what you're doing is not legal at all. And then advertising. I mean, I see people advertise stuff all the time. You can't do it. You can't send out mass emails. Hey, we're doing this, we're doing that. We got this indication. You can't do that. You can do case studies in education. That's why I'm here doing this education, right? A couple of case studies, because then you guys get a flavor of who we are. And, hey, these guys might be cool. I'd like to learn more. What does he all do? We get to meet a couple more times, and then you invest in our fund. So you can do case studies in education, but you can't go out there pitching stuff. I mean, it just doesn't work that way. So let me give you guys some warnings here. Read the documents. I'm amazed how many people come through my office that have done syndications with other syndicators in town, never read the documents, and then when the deal started to fall apart, they've started reading the documents. So read the documents, and this is what I call the weight test. Money and how big is that stack? I don't have any notes sitting here with me today, but how thick is that stack? If you guys ever wrote a dissertation or a thesis, when I did my thesis for one of my master's degrees, we had the weight test. So one of my faculty members would pick it up and he'd go, I don't know, this seems like about right, 80, 90 pages. We might have something to work with here. So the weight test on a basic note, our basic note is 23 pages. It's $500 in legal fees. Our syndications cost about 15 grand and they're 105 pages. And then our funds, 25 to 100,000 bucks, and they start at 125 pages. So you really got, if you get this like one-page note, that's probably not going to work. I've seen some of these syndications where the pro forma is longer than the PPM. It's kind of crazy. But yeah, the business plan is actually longer than the PPM. It's kind of funny. So we've also got to be mindful of our vocabulary. When someone's lending to me, are they a lender or an investor? And in a syndication, we've got lenders, investors, partners. We may have GP, LP relationship. And in the funds, what do we call these people? Are they investors or who exactly are they? And what I see a lot of people do, what's really interesting, is they start advertising their notes, and then they'll say, we're looking for investors. And I'm like, whoa, what are you doing here? Are they lenders? Are they investors? What? Now it turns into a real convoluted mess. So there's a couple of takeaways here for the golden rules. You must have a relationship with these folks. Unless you have a fund. Like our fund can publicly advertise. I can put, my office is right here off of 290 in Hollister, in between the Beltway and 610. So practically, I'm inside the city of Houston, right? I can buy one of those billboards over here, and I can see 290 from here. I can see the billboard, and the billboard says, Jason's fund pays 18% or 8% preferred, and then we do another 14% preferred, what we call a kicker at the end when we sell everything out of the fund. Not a bad deal. I could totally put that out there. Here's my number. Give me a call if you want to get invested in real estate. But I can't do that with my syndications. I can't just put my syndication out there and says, hey, we're raising money for this syndication right here. That's just completely not legal. I prefer to deal with sophisticated investors, sophisticated and accredited investors. There's kind of accredited investor has a very specific definition. Sophisticated is kind of you got to pass the sniff test. So a lot of times I ask folks, let's say they want to put 25,000 bucks in with one of the things that we're working on. And I'll say, hey, look, man, if you lost this $25,000, we don't want to lose money here. But let's say you lost that entire $25,000. Are you destitute at that point? What you got going on job-wise? How much money you make? What other investments have you done? That's another thing. If I'm working with another real estate person, I'm like, well, how much real estate do you own? Well, I own an apartment here, and I own this, but I used to own these other couple of things. I'm like, all right, even if you're not accredited, you sound sophisticated, right? And then know the risks, and then always read those disclosures. So again, the relationship's got to be more than just emails. So for us, like we have students in our mastermind, and we do have joint venture agreements with folks that we actually do joint venturing with. Go to networking events, introductions, the coffee, lunch, webinar. We do webinars all the time. So and of course we document who's on there. We do networking events and meetups, like I swear, like every day. We had one last Friday. It was great. I got to meet a ton of people. So I know what's going to happen. I got to meet all those folks. And then we'll do another event. We'll get to hang out some more. And then we'll probably go out for a coffee, lunch, happy hour, dinner. So there's an established relationship there. And I'm not sitting there pitching them on my money or my deals or any of that other stuff. I'm like, hey, I'm in real estate. What do you do? I'm a real estate guy too. And you start trading real estate stories there, and you've got an established relationship. This is us here. This is the Texas Real Estate Investment Center. It's a beautiful building here. If you guys actually want off, we've got office spaces in here. They're, these little executive office suites. If you guys are interested in one of those, just give me a call. This is what we do. Last three syndications, those are the numbers that we've got. We had the American Recovery Fund, which is, we just closed that. It's a 15% return per year. And then we've got the Texas Appreciation Fund, which is open now. Again, this is a fund that we can publicly advertise to. So if you're a passive investor, come give us a call on one of those things. And then an active investor, we've got the mastermind, partnering on syndications and funds, and we find deals just like you guys have seen this presentation. I mean, we find deals all day long. I'm in this marketplace while I've been sitting here. I don't know if you guys can hear it on your end, but while I've been sitting here, I'm just getting like text message after text message after email of, hey man, take a look at this deal. What do you think? So if you guys are interested in investing with us, that's our number. Haley, that is it for me. I wanted to give ample time for questions because I can hear the questions coming across. So let me do this. Let me stop my screen share. And then we can go look at the questions. Can you see the questions on your end? I don't know if I can see them over here.
I can, yes. So guys, if you have questions, be sure to send them to the Q&A box now. We don't have any yet, but I do have a few questions of my own. So okay. Out of all of your investments, out of everything you have going on right now, what are you most excited about? Which one has you the most pumped up right now?
Well, you know what? Since we're waiting for questions, can you, let's see, let me see if I can get the screen share back. I'll show you the one that I'm most excited about because it's the craziest one. It's the one I did for y'all's case study. Let me see if I can pull up. I think I got it right here. It's the one I did for y'all's case study last week, and it's just a crazy little deal. Hold on one second. Oh, do I not have it sitting here on my desktop? Oh, here it is. Yeah, it's this one right here. This little house. So I bought about 15 beach houses down in Surfside, Texas over the last year and a half. And this is probably the most exciting one. This was actually on the beach. If you guys don't know where Surfside, Texas is, you drive down 288 until your tires get wet. You just go straight down 288, past Freeport, there's Surfside. I was buying properties down here a year and a half ago for 250 grand. This one's actually on the beach. I'm paying $380,000 for it. It is 672 square feet. We're approaching quickly $650, $700 a square foot out there. And this thing will rent all day long between $3 and $350 a night. So the whole business case study behind this is we're actually going to raise the property up another 12 feet. I'm going to add another 1,000 square feet on the back. It should hit $1.1 million in valuation. I'm going to be all in for about $580,000, $600,000. And it will net, I'm actually going to sell the other beach houses in the market to pay this one off and the construction. It's going to net about 14 grand a month from one house, 1,600 square foot house in Houston, Texas. So that is the most exciting deal that I've done, at least this year. This is the most fun one. It's a good way to put it.
Nice. Very interesting. We do have a question here, and hopefully I asked this correctly. How do I secure funding by setting up a real estate LLC? I think that's what they're asking. Or how to secure funding by setting up real estate LLC.
Well, let's ask the question a different way. What are you trying to accomplish? People, and go ahead and just write that in there, and then I'll address it while you're typing it in. But here's what 100% of real estate investors do when they get in. They go to a seminar, they hear something, they're reading Bigger Pockets or on a podcast, and they're like, I need a real estate LLC. And I'm like, whoa, let's back up. What are you trying to buy? Because what you buy, your business plan will dictate your financing. So let's figure out the business plan first, then let's figure out the financing. So have they typed in there what they're trying to do?
Yeah, he said, I am trying to get investors to fund my house purchasing.
Okay, so you gotta understand what you're asking here. So you want to approach investors to fund deals. So you're already automatically pooling money. Like you're pooling money now. You've just gone from something really, really simple to something professionals do. Now, if you're just trying to buy one house at a time, this is how, when my first 5 years in this business, I didn't do syndications or funds. And I bought over 1,000 houses. And this is how I did it. I'd go up to Quest Trust and I'd be hanging out with a bunch of people, and somebody would go, hey, Jason, I might be interested in being a lender, a private money lender on one of your deals. And I go, oh, okay, well, how much money you got there, Bob? Well, I got $200,000. And I'd say, great. I got a house I'm buying for $125,000. I'm putting 50 into it. I need 175 grand. You want to do that? They go, yes. But they do not fund an LLC, and I do not pool their money with other investors. Once you start doing that, you go from something that's really, really simple to something that's incredibly difficult. Now, don't get me wrong. If you want to get right into syndications and call an attorney and spend the 15 grand and get a syndication together, and you're going to meet all those legal definitions, go for it. But if you're just trying to buy, I mean, I did this with 100 houses a year. I don't know anybody that goes out and buys 100 houses a year right out of the gate. So I'm telling you, unless your business is going to be way bigger than that, you can literally just go to Quest Trust, some of your friends and family who've got IRAs from past employers, and just put them into your deal. Now, again, you can't pool money. They're not investing in the LLC. Make it real simple. First deed of trust loan for that single family house. As soon as you start commingling, as soon as you start pooling money, you got to get an attorney involved, and it gets really expensive really quickly for what you're trying to accomplish.
Mm-hmm. Yeah, great information there. I'm going to rephrase this one just a little bit because I actually don't think we talked about this. One of our attendees has a question. We are trying to raise funds for storage and land development into lots for national builders and retail sites for vertical constructions. Do you have any experience here? Do you have any insight? They asked if you covered anything like this, but I don't think you did. So I want to see if you have any insight.
If we've got experience in it, my business partner Rob does. I'll tell you this, if you don't have any experience in it, this might not be the deal for you. This is, when you start to get into development, it is really, really tough. And here's where people mess up on development. If you're not 50% or less of what the end value of this thing is going to be, you're going to lose money. I'm telling you right now, you're going to lose money. Now, here's the other thing with development. A lot of people miss, and we're getting into our first development project now. But again, Rob has been doing this for years. Most investors have no idea how long a real development project is going to take. It starts with years, not one, not two, not three. It's years. Now, if you're just going in, clearing the land, and you're not doing all the civil, it's a little bit quicker, and then you can subdivide the lots and sell it. All you really need is somebody to go in there and clear the land. You need a guy that can go in there and break it up into lots. It's going to work with the city that's got experience doing that. And then you can subdivide the lots and bang, you're out the door. I have a friend of mine that does that all day long. When you start to get into real land development, you got to bring a civil engineer on board in-house. In fact, we had an interview with one 2 days ago that we're probably going to bring in-house. He's retired. He goes, I'd love to work with you guys on that. So you really need a specialist that does that. Now, as far as the funding side, I do it either as a syndication or a fund, but I probably just do it as a syndication and raise the money and do it that way. But whatever you think your hold costs are, double them. Because that's another thing. When I see these pro formas, they don't have enough hold costs in there. You get stuck with something at the city, and it takes another 5, 6, 8, 9 months. Or somebody on your team says something at a meeting, and maybe you don't have the best reputation with the city. They'll sit on that stuff forever. So you really got, and again, let me back up here. is that what you really want to meet your goals? What I find a lot of people get into development work, they really just want to retire and they want to own some rentals and make a little bit of money. But the problem is that they lack the skills to be an investor in this marketplace. So they go into something like development because they think it's easier. And I'm like, when you start to get into development work, if you meet some real developers, those guys are sharks and they're extremely sharp. So I'm always hesitant when somebody says, oh, now I'm going to be a developer and I've got this tract of land and this and that. It's been on LoopNet, but it's been passed around to all these different developers and they've all passed on it. I'm like, well, there's a reason they did. In fact, most developers, when you look at the developer marketplace, most developers bought that land anywhere between 5 and 10 years ago. Like the real big developers, their time horizon is crazy long. So anyway, that's just my unsolicited advice. But because like I said, Rob's been in that space. We're getting back into that space. And yeah, you really need some expertise on board. The funding is there. Financing is there. It's available. But I'd really look at your team. Who's really done this before? Because it's not like single family where it's like, I got a good deal, I can hire a handyman to come out here and do the work. And you really need, it's a real business. I'll put it that way. It's a real business. It's serious stuff.
Nice. Very interesting. We have another question here. Do you have any experience in raising money for Airbnbs?
Yes, tons of it. You're looking at one right there. Yeah, we do Airbnbs a bunch of different ways. Here's the challenge with Airbnbs, and that's the long-term financing. And there's only a couple of companies right now that offer long-term financing for Airbnbs. And there's some ways to make your loan profile look better where they will fund those. But yeah, you can absolutely raise money for Airbnbs. It's just single family with short-term rentals. Yeah, now I will tell you this. One place where people get tripped up on Airbnb financing is they get these really big, expensive houses. And early on when you're starting out, they're going to look at your debt to income ratios and to see if you can actually carry. It's called the ability to repay rule. If you guys want to get into the real nerdy mortgage stuff, but they're going to look at it just like a regular rental. In fact, they're going to look at it like a regular rental that doesn't have any rental income. Now, we've had a lot of success with local banks because we show them, like, I own 15 of these down here, and I just show them, like, here's all the financials from the other ones. They're like, yeah, let's go do it. So they're not even worried about ability to repay, and that's where because they've already seen it. Now, keep in mind, Airbnb is not investing. You're in the hospitality business. This is a business. This isn't, I'm going to be a little real estate investor and I'm going to spend, this is not passive. I'll tell you right now, it's in passive. I got a whole team of people that literally, like, I get text messages all day long in my WhatsApp group, and it's all for my Airbnb stuff. We had a guy yesterday somehow forgot to book out this Airbnb for another 3 days, and we were going to call the cops because he wouldn't leave. And so there was this big miscommunication between us and Airbnb and the guests. It was a total mess. So you're going to be dealing with that stuff, and you're not going to be dealing with it, at 2 o'clock in the afternoon on a Tuesday when you have time. It's going to be 5 o'clock on Friday when you're at happy hour and the cops are showing up. So just keep in mind that it's a little bit more active, but yeah, there's financing out there for Airbnbs, absolutely. And you can put together, if you wanted to, you can do a syndication for it. You want to buy 30 or 40 of these things, put a little syndication together, go out and buy it.
Mm-hmm. Very interesting. On the subject of Airbnbs, I actually have a question myself. So I know, we've talked about this, my boyfriend and I, we've got one in Austin, we've got one on Lake Conroe. Do you prefer the Airbnbs that are a little bit smaller, maybe house 4 to 5 people for the weekend? Do you like the larger ones that can hold a lot of people but might generate a lot more income? Do you have kind of like a sweet spot there? What's your opinion there?
So I know you're familiar with rental, intimately familiar with rental property, especially given your family, right? So I'm a huge fan of rent per square foot. So 99% of the time, the small houses make way more money than the big ones do on a per square foot basis. Because you also know my costs are on a per square foot basis, right? And you got to remember too, in Airbnb, you're paying all the utilities. So in Texas, especially where you guys are at, because it gets 117 there in the hill country, right? And of course, guys, now, if you guys don't know, Haley's got a place that's close to really 2 big mountain bike parks in Central Texas. So these guys come back from riding all day. They want to crack a couple of beers and they set the AC on, 68, right? Or, 65. So The bigger house, it's probably not going to be 20 guys here. It's probably 7 or 8, right? As opposed to a 3-bedroom house, it's maybe 6 people. So our preference is always smaller on just about everything that we do. We really like the smaller stuff because on a per square foot basis, it just rents up so much better, and the costs are smaller in aggregate, right? Because the per square foot cost can be the same in a big house, it's going to be a small house, but if my revenue's higher in a small house on a per square foot, I've got my net is higher. It's probably a better way to put it. Mm-hmm. And then you can run into some really weird issues with like big houses. You get certain insurance carriers that don't want to cover them. Let's say your house is burned out, it was like 5,000 square feet instead of, I don't know what it is, 1,500. If you get into like some weird stuff there, when the further out you get from the mean, the less market there is for it. It's probably a good way to put it. So I'm always a big fan of smaller stuff as opposed to bigger.
Nice. 2-bedroom, 2-bathroom is looking pretty hot right now. That's good to hear. Yeah, it's the perfect size. This will be our last question here. If I were to do a syndication, would it be better to raise money for maybe a 4-plex or an individual unit?
I wouldn't do a syndication for a 4-plex. Fannie Mae will fund a 4-plex. Like if you guys are doing anything in single family, there's no point in doing a syndication or fund. You can literally buy 100 of these a year by just going to private lenders and networking and saying, hey man, this is what I'm doing. And they go, yeah, I'm a lender. I got $150,000, and then just make a note, build a note in there. It's so, trust me, like syndications and funds are for the bigger, more complicated stuff. So like our fund now is essentially an appreciation fund for single family. We're building it up to 30 million. So I'm in the middle of raising $7 million. We're going to leverage that, and we're going to go out and buy $30 million worth of real estate. That's a pretty complicated thing, right? I think for most people, 99% of folks out there, just do the whole first deed of trust. Just go over there, borrow some money. In fact, here's what I'll tell you, especially on single family. And this house right here is a good example. So I'm paying $380 for it. I think it's worth $410, $430, something like that. And I'm just borrowing all the money from a bunch of buddies of mine. In fact, it's all the guys actually, and one gal who's a photographer, amazing photographer. But it's a bunch of buddies I hang out with that I've got a lake house with. So they all said, yeah, man, let's all pitch in on a beach house. I'm like, okay, fine. But in 6 or 7 months, I'm going to refinance this thing. I'm going to take 100% of their money out, and I'm not going to have any money in this deal because it's got so much equity. So here's what I would do if I were you guys. I would go out, buy your single family house, use somebody else's money, do a first deed of trust note, nothing complicated, and then wait 6, 8, 12 months and then refinance them out. You're probably not going to have to bring anything to closing because the appreciation is going up so high. So that's how I would do it. It's easy. The financing is easy. You don't run into a lot of legal ramifications with pooling money and all that other stuff. Now, if you tell me, hey, Jason, I've got to pool money because I don't know any lenders, like you need to go talk to more people. Like that's a whole separate thing. Like, trust me, Haley, you live this world. Like how many accounts, like guy walks in, he's like, I got 200 grand. I don't know what to do with it. I'll just transfer it over. Like they're everywhere. Everybody's got a couple $100,000 sitting in an IRA somewhere. Or maybe they got some in their IRA and they got some over here and they got like there's a way to make it all work. You just got to kind of get out there and start having conversations.
Mm-hmm. Definitely. And I think that's a great point to end on for today. Guys, be sure to join us at our upcoming virtual networking happy hours. We get people from all across the US, a lot of investors looking to deploy capital, a lot of people looking to connect with other investors. So Kurt did plug that in the chat just one last time for you guys. But Jason, before we sign off for the day, do you have any maybe like last final thoughts or piece of advice for our audience that's still out there?
Oh, I always do. It's that right there. Let me give you guys some economic data, just real quick. So 2008 to 2019 was the slowest and worst real estate recovery that we've ever experienced. What you're about to see in this next phase it will be the best real estate market we've ever experienced in the United States. Like, I'm not kidding. This is just getting started. So that's my contact information. You guys want to reach out to me. Don't wait. You've got to get out there and start buying this stuff. Like, it's getting crazy expensive. And if there's one more last thing, hey, like I keep forgetting to tell everybody this. If you don't own the house you live in, you need to do that right now. Like the most important thing is you own the house you live in, because they're appreciating $50,000, $60,000, $70,000 a year, and they're not going to go down. Like people think like real estate crashed in 2008 in Houston. It didn't. It just stopped growing so fast. Or stopped appreciating so quickly. So buy your personal residence and then start going out and buying some of this real estate.
Mm-hmm. Awesome. Well, what a great note to end on for today, guys. Be sure to check out that QR code. It's got all of Jason's information. He also has a really awesome radio show for those of you guys that don't know. So I'm sure that information is probably in the QR code as well. But Jason, thank you for joining us today. It's always a pleasure to have you here. I love seeing all of your data that you look up and mine every single week. To all of our attendees out there, thank you for joining us. I hope y'all enjoyed the class. You can rewatch today's class as well as all of our other webinars on our YouTube channel. And that's all I've got. I hope to see you guys at our other events, and y'all have a great day.
Great. Thanks, guys.
Bye, Jason.